Market making in DeFi are today represented by automated market makers like Uniswap, Curve. And the reason why we decided to target market making is that we think that the products today of automated market makers are not really investment products. We think that they are casino products and that they don't provide satisfying risk and return profiles to liquidity providers. And this is due mostly to a phenomenon called impermanent loss. So what we build with Swaap is an AMM that is aiming at strongly reducing impermanent loss. And we have been live on Polygon for approximately 5 months already with a strategy that has been very successful so far.
Welcome to the Deus Ex DAO podcast.
Welcome everybody to another Deus Ex DAO podcast. And in this podcast, we have Cyrille as a guest who is active at Swaap. And Swaap is a new AMM or has a new AMM design and is active on Polygon. But before we ask Cyrille to introduce himself on Swaap, I'm also joined by Kepler, who is my co-host today.
Hello.
Hey Kepler, good to have you here. You were in contact with Swaap and invited them to come on our podcast. Before we kick it off, why did you think Swaap was an interesting guest to have on our Deus Ex DAO podcast?
Yeah, I mean, they have a different take on AMMs. I don't want to spoil it, but that was the interesting part to me, that they basically are really looking at the LPs and are focusing on them. And yeah, I think that's an interesting approach to just experiment more of what is possible with AMMs. So that's why they are here today.
Awesome. Let's go into the Swaap workings then. So welcome, Cyrille. Could you introduce yourself and summarize Swaap shortly so the listener knows a little bit what we will be talking about in this episode?
Hey, Kepler. Hey, Apertures. Thank you very much for having me today. Really excited to be able to share our vision around AMMs. So I'm Cyrille. I'm the co-founder of Swaap. I'm more focused on the business side, and I started Swaap a bit more than a year ago with my co-founder David, who is more focused on the tech and research side. So to introduce Swaap, essentially our mission as a company is to provide passive and profitable yield strategies to any kind of liquidity providers. And the way we are doing it is through market making. So market making in DeFi are today represented by automated market makers like Uniswap, Curve. And the reason why we decided to target market making is that we think that the products today of automated market makers are not really investment products. We think that they are casino products and that they don't provide satisfying risk and return profiles to liquidity providers. And this is due mostly to a phenomenon called impermanent loss. So what we build with Swaap is an AMM that is aiming at strongly reducing impermanent loss. And we have been live on Polygon for approximately 5 months already with a strategy that has been very successful so far.
That's great because, as we have seen from previous research during the last bull market, a lot of these liquidity providers have lost mostly because the impermanent loss, and they would be better off not providing that liquidity, which is a problem because we need those people to provide liquidity to trade against or have a good and active decentralized finance. So could you run us through what makes your automated market maker different from what we have in the current markets? So, for example, we have UniV2 versus Curve, and they have different goals. What is your AMM optimizing for?
Sure. So I would say first, our AMM is aiming at really optimizing the yield for the LPs. I mean, not only the yield, but the risk profile, the risk adjusted yield that they're going to get from market making. And we're really focused at the LPs. And I think this is a very big difference with the other AMMs. And the other element is that we're deeply focused as well on highly liquid large cap tokens. We are not an AMM for like shitcoins or long tail tokens. And this is due to our design essentially. So I think in terms of, if I were to describe it more like philosophically, what distinguishes us from the traditional AMMs, there are basically two main elements. The first one is we believe that DeFi will be the future infrastructure of the financial system. But we believe this is not going to happen on Ethereum layer 1. The reason for that is that when you are on Ethereum layer 1, you need to compromise on a lot of things that are essential to have strategies that are effective in finance. And this is due to like the low TPS that happens on Ethereum layer 1. And the problem is today that 99% of the AMMs that are live have optimized their design for the constraints of Ethereum layer 1. So they are probably doing a great job, like the best job that you can on Ethereum layer 1. But it's still a very unsatisfactory design, which compromises on two things which are essential in finance, which are information and math. If you take a look and you step back and you take a look at how people generate performance in finance, in TradFi, actually, usually information and math are key. So for instance, hedge funds in TradFi, they buy satellite data in order to estimate in advance the production of oil. And basically, in DeFi, current AMMs don't integrate any kind of external information. They are completely blind to the outside world. The other thing which is key in TradFi to generate performance is math. If you study the returns of the best hedge funds over the last 40 years, the ones that were the most consistent are actually the ones who managed to hire the best PhDs in math and physics to design their algorithmic strategies. And the issue is that the math of the current AMMs, while very robust, are using the constant formula, x time y equals k. And this formula is very basic and simple, and it allows way too much room for other actors to extract value from those products. The other main guiding principle that distinguishes us from AMMs is that essentially there are three types of users in traditional AMMs. There are the liquidity providers. There are the traders that actually want to trade and are willing to pay a commission for that. And there are the arbitrageurs. And the arbitrageurs are just here to extract value. The transactions they perform, by definition, are purely EV+. But the problem is that this value actually comes from somewhere. And the somewhere is the liquidity providers, because that value is extracted from the pools. And so indirectly, what that means is that with arbitrage volume, what we get is lower yields for LPs, but also higher fees for normal traders that are just here because they actually want to swap an asset against another. And so today, 70% of the volume on UniV3, for instance, on USDC versus ETH is arbitrage. Essentially, that's one of the reasons why LPs cannot make money on traditional AMMs. So at Swaap, we are focusing on three things: information, by having frequent Oracle updates; math, by having very advanced models to compute our dynamic fees; and reducing, that enables essentially to us to reduce the arbitrage flow that happens on traditional AMMs. And that's how we're able to give better risk-adjusted strategies to LPs.
That's cool. So let's dig deeper a little bit. Could you maybe explain how you essentially price assets? So basically the first two parts, the information and the math part, because you're not using like the normal XYK formula, right? You're doing it proactively because you saw that basically being just a passive liquidity provider leads to impermanent loss. So yeah, could you explain that in simple terms, how you price the assets and how it's different to like what people generally understand as like an AMM?
Yeah, sure. So if I were to do that, I maybe need to come back to exactly how we handle assets within our pool. And I'm going to make it as clear as possible. So essentially, if you think about how an AMM adjusts its pool and manage its pools, it's based on a strategy which is a rebalancing strategy. Essentially, an AMM adjusts the quantities of assets based on the prices of the assets. And what it does is that each time an asset increases in price, it will lower the quantity of the assets in the pool. So that it's a bit like being always short on the asset that performs best. So what we do at Swaap is that we took an opposite approach. We are focusing on developing a strategy which is hodl-like. So essentially, the idea is that, for instance, let's assume that one ETH is worth $1,000, and you have 10 ETH and 10,000 DAI in the pool. So what we're focusing at Swaap is to keep the 10 ETH and the 10,000 DAI, no matter the price of ETH. So if the price of ETH rises to 2,000 DAI, we will still keep approximately 10 ETH and 10,000 DAI. And what will happen in a traditional AMM is that they will adjust the quantities of the assets to the price of ETH. So probably they would have like 7 ETH and 14,000 DAI approximately when the price of ETH moves from 1,000 to 2,000. And that's actually what creates impermanent loss, is that you're always short the best asset. By doing such an approach where we keep the same quantities of tokens, it creates essentially two problems. Because we break the relationship between the price and the quantities of the assets in the pool that you find in a traditional AMM. So the first problem is relative to the price. How do you define the price? And the second problem is relative to the quantities. How do you maintain this ratio of quantities while people are going to interact with the pool and they're going to trade? If you start to trade 1 ETH with my pool, now I have only 9 ETH and let's say 11,000 DAI. So if the price of ETH rises, I'm going to lose money actually, because I will have a short exposure to ETH compared to my initial inventory. So for the price part, what we do is that we introduce oracles. Oracles are great because they enable us to reduce strongly arbitrage, because instead of paying arbitrageurs to update the prices in our pool, which is what traditional AMMs do, we just use oracle feeds. And this is a much cheaper approach. The main problem of oracles is MEV. Essentially, oracles can be front-run when they are published on chain. So a front-running is a transaction that essentially takes advantage of knowing what the oracle update is going to be to do two transactions that are going to profit from this information, essentially. And the problem is that the larger the deviation of the oracle price, the larger the front-running opportunity. So what we do with Swaap is that we have models that are fully implemented on-chain and that try to predict the risk that the oracle is going to deviate by a lot from the previous oracle updates. Those models are essentially here to assess the volatility risk. And the bigger the risk, the bigger the fee that we're going to charge. Why do we increase the fee when the volatility is higher? Essentially because we want to avoid any front-running. And if we increase the fee, the front-running is not profitable anymore. So people don't front-run and LPs don't lose money. The issue is that, of course, if the fees are too high, you never get traded and you don't make money. So what we do is that when we think that the risk is low of the oracle being updated by a strong deviation, we reduce the fees so that it's much cheaper to trade on our platform. So first component of the price is the oracle. Second is like the volatility fee to counter the front-running. Then we have kind of margin for the LPs, which is actually the yield that you're making in the end. And then what we have is we have a slippage component. And the slippage component is here to answer the second issue that I highlighted in our design, which is how do you ensure that the quantities are stable to keep this 10 ETH, 10,000 DAI quantities in the pool at all times. So what we do is that essentially we are going to see if a trade imbalances or rebalances the pool. Let me be clearer about that. Essentially, imagine that the pool has 10 ETH and 10,000 DAI. So it is at its target balance, which means that if a trader trades with the pool, that trader is going to imbalance it. So it's going to put a risk on the LPs, the risk that an asset is going to vary in price, while the exposure to this asset is different from the target exposure. So for instance, if someone buys 1 ETH from the pool, now the pool has like 9 ETH and 11,000 DAI. So if the price of ETH rises, again, the pool is going to lose money. So what we do is that when you do so, you're going to pay a slippage, and let's say $1 of slippage, 1 DAI of slippage. So and this dollar of slippage is going to be given to the person that is going to rebalance the pool. So, for instance, in this scenario, there would be potentially, this can go up to an arbitrage opportunity, someone who wants to sell ETH to the pool. And so that person, instead of being paid 1,000 DAI, which is the price, will be paid 1,001 DAI, thanks to the dollar that has been paid by the previous trader. And that's how we can maintain stable quantities. So the pricing function essentially has like 4 components: an oracle as a mid price, the volatility fee to counter the front running, the margin of the LPs, which is kind of the yield in the end, and then the slippage component to maintain the quantities stable.
The slippage sounds similar to like the funding rate for perps. Is that correct, or are there like big differences?
To be honest, I'm not a perp expert, it's mostly similar to AMMs, like traditional AMMs. The big difference is that the starting point is we already have a mid price as a starting point.
I think like the philosophy is the same, where you try to disincentivize some deviation from what you think is true pricing. Although in perps, that's like the spot price. But for you, that would be like the balance in the LP pool. So
Exactly.
it's slightly different from the perps in that aspect. But in a way, if you are on an overrepresented part of the trade, you will pay more, or if you're in an underrepresented part of the trade, you will pay less in fees. So in that aspect, you can compare it to funding. But this would require also that if you have this for an AMM, you want to have liquid markets, as you said earlier, because if you do this on less liquid market, people might not be incentivized to make sure that that imbalance gets corrected and puts those funds in the pool. So one of the questions is like, what assets will be tradable on Swaap?
So, I mean, Swaap is already live, and currently we have a pool with we just have one pool actually. We have a pool with USDC, ETH, and BTC. Like you're totally right, we are focusing mostly on liquid assets and high cap tokens. So there is this issue of like ensuring that we are rebalanced fast, but I would say it's not a problem once you're listed on 1inch, Paraswap, etc. The main issue and the main reason why we focus on highly liquid assets is for the models that try to estimate the volatility deviation. So essentially, those models tend to perform better on assets that are highly liquid. And if you have an asset that is less liquid, you need to increase essentially the fees to be more protected. So essentially, if we were to go like on more long tail assets, we would probably have an increased price point. What one needs to keep in mind though is that the market of like the main assets is by far the largest one in DeFi. So for instance, on Polygon, I mean, I made the analysis 6 months ago, so I will need to update that. But Matic, BTC, ETH versus stable represents, I think, more than 70% of the market. So it's really concentrated on like a few assets. And that's why we tend to focus more on those assets, and we will never go on like really long tail tokens. We prefer to provide yield solutions for highly liquid large cap tokens.
Yeah, and I think that's quite a good choice. For example, if we look and compare to GMX in the GLP pool, they have next to BTC and Ethereum also Uni and Link, but it's so underrepresented in that pool because users don't trade that much. They mostly trade Ethereum, for example. So it would be logical to focus on that, build a product, and then maybe see if you can slowly add some other like higher caps to your AMM.
Maybe if I can add something to that. Also, one difference between Swaap and the other AMMs is that the driver of the performance is actually different. Essentially, when you're in a traditional AMM, the main factor to take into account in your performance is how the prices are going to evolve. Essentially, And this is part of the reason why I say it's casino product, is that you're betting that the price will move favorably in your direction, which means they're going to deviate from your entry point to have volatility. And then they're going to come back to your entry price so that you don't have impermanent loss. That's what you're betting on. And at Swap, what we build is a strategy that's not driven by the evolution of the prices, because we still keep approximately the same quantities of assets as you start with. It's a strategy that's driven mainly by the trading volume, like the real trading volume. Do people like to trade this token or not? And are they trading it? So if you don't have volume, like this is a problem, because you don't have yields, essentially. So that's why we're also focused on assets that have a real demand.
Sounds logical. And you also said earlier that you have these more liquid assets because you can develop your models better for predicting that volatility. Could you go a little bit into the specifics of that research? Like, how do you research predicting volatility?
Yeah, and maybe also to add, like, who was on the team, for example, doing the research.
Sure. So I'm just a business guy, so it was not me. But my co-founder David essentially developed the first version of our product, the one which is currently live and which has been live on Polygon for the past 5 months. So essentially, impermanent loss is a big issue in DeFi, but it has never been an issue in TradFi. And market makers in TradFi are perfectly profitable. So how could we basically try to import some market making ideas and more in philosophical principles and integrate them in a DeFi setup, like adapt to the infrastructure that is used in DeFi? And that's the way we kind of ideated on how to modelize, to design our models, essentially. The idea was what we think essentially is that DeFi has amazing potential. We think that this is going to be the new infrastructure for the financial system because it enables democratization of financial products. It enables permissionlessness, interoperability, security, transparency, 24/7 activity. But we think that it doesn't change math. We think math are immutable, and the math that worked well in TradFi should work well in DeFi as well, even though you have to adjust for some infrastructure constraints, of course. So that was like the starting point. And the way that we stress tested the model afterwards was, first we ran a backtest on approximately 5-6 years of data to ensure that our model was working well. And we compared that to Uni V2 essentially. Then of course we went into production. So now we have live data around our product, and which I think are very interesting. So essentially, if you look at the performances of AMMs, there was a recent P&L deconstruction of Uni V3, which showed that the average P&L of liquidity providers on Uni V3 is around minus 1%, with a volatility that is huge. So a lot of risk. At Swap, what we developed was essentially a low risk, low return strategy, and which has positive returns, while most of the AMMs out there have negative returns, which has 10 times lower standard deviation than other AMMs, and only 2 times higher standard deviation than collateralized lending protocols like Aave or Compound, with approximately 5 times the returns on the assets that we are listing. So that's the live, the live stress test of the data. And now we've built something even more exciting. For the V2, we are collaborating with amazing researchers in order to build the future of our market making algorithms. So we partner with an institute called Louis Bachelier, and notably with a researcher named Olivier Guéant, who is a mathematician and a market making researcher in TradFi. He has more than 2,000 citations on Google Scholar for his works on market making. And he basically did his PhD and founded a company with someone who has the Fields Medal, which is the Nobel Prize in Mathematics. And together with our researchers, we're publishing a research paper, essentially, where we developed a simulator. Essentially, the idea is that DeFi is only 4 years old, and this is not a lot of data in order to assess the efficiency of market making strategies. So we wanted to turn those 4 years of data into 1,000 years to be able to really assess the risks and the returns, the expected returns of various market making strategies in different setups. And so we built this simulator, and this is how we're going to build our new market making strategies. So right now we just have a market making strategy, which is a low risk, low return strategy, so a safe one. We want to also address different risk profiles. So we're for the V2, we're going to build a strategy which is going to be more focused on high risk, high return, essentially.
Could we talk a little bit about the Oracle-based pricing? We have talked a little bit about the benefits of this AMM versus some others, but if you use oracles, you're dependent on other venues basically for pricing. What's the benefit of this, and what's also the trade-off maybe? Why would you still need that outside data?
Sure. I mean, the main problem with not using oracles is that you're paying arbitrages to give you the price, essentially. And this is much more expensive to pay arbitrages than to use oracles. The main compromise, of course, is that you're reliant on an external source of data. And this is, I mean, you can mitigate that. Of course, it creates like potential manipulation problems. And we've seen like attacks, for instance, on GMX and Mango markets, which are reminiscent of that. What we have chosen to do at Swaap is to have a really careful approach. So we have much more many more protection mechanisms than other products. So for instance, we have a timeout mechanism. If an oracle is not updated soon enough, the smart contracts pause trading essentially, so that it cannot be like you cannot trade with the price of oracle, which is too outdated. The other things that we implement, for instance, is whenever there's you cannot go to do a big deviation of the reserves, of the target reserves of the pool. Essentially, there's a limit. We normally set around 2% of the target reserve of the pool that you can change. So what this means is that if the price of the oracle is manipulated, the attacker will not be able to extract more than 2% of the pool. And then I think the other element is that companies like Chainlink, which we're using, have a great history of maintaining super high quality data feeds. So that's the other element. I think in the future, we will not necessarily need like off-chain oracles. What we believe is that potentially trading is going to happen on-chain on an order book or a simplified form of order book. And then what you just need to understand is what is the market price. And this can be obtained through on-chain data, and it doesn't need to rely on an off-chain price discovery. So the model of Swaap is actually fully compatible with an on-chain order book in a way, because then you just have to place orders on that order book following the market price given by the order book.
Yeah, I think like the order book is really interesting that you mentioned it. So because we talked a lot about like Swaap versus other AMMs, could you maybe also elaborate on like Swaap versus order book? What are the pros and cons there?
So actually, I think it's not really a question of pros and cons. It's more a question of what we are doing. So essentially, I think basically Uniswap and other AMMs which work without oracles, what they are trying to build is a combination of actors like market makers like Wintermute or Jump, plus, I mean, if I take really like CeFi example, plus Binance or Coinbase anyway. They are a merge of those two because they are a place where you can deposit orders, but at the same time, they are also a market making strategy. And so they are in competition with all of those actors. At Swaap, what we do is that we're actually more focused on the market making side. So we don't really try to compete with like places where traders trade. We are mostly focusing on integrating with aggregators, which are, I believe, simplified forms of order books in a way. And I think we compare ourselves more to like Wintermute or Jump, but in a decentralized way. So we are more trying to be a decentralized market maker than an order book. We are very complementary to order books. And the day when an order book that actually manages to get a lot of traction on chain happens, we will be able to integrate with such order book and provide just fill orders like a traditional market makers does on Coinbase or Binance. Just it will be programmatic and not done by a human.
I see. So, like looking forward into the roadmap, I guess that would mean that you don't really see Swaap as kind of like the standalone product that it kind of is right now, but more as like a protocol that gets integrated into other products basically, and is like the DeFi market maker there in a way.
Yeah, exactly. It's totally that. And I think this is one of the great things about DeFi is that, I mean, DeFi is such a, I think it's a composition of Lego. And the really cool thing is that everybody can focus on doing something very specific very well and then integrate with others super fast to create amazing products. And really, that's what we are trying to do at Swaap. Our edge is that we're really good at building market making strategies that are efficient and that work. So we are purely focusing on that, and we allow others take the trading side, essentially. So yeah, we're not focusing on trying to attract traders on our platform. We're really more focusing on attracting LPs, for instance. And of course, we want to integrate with wherever it makes sense. So another topic that we are working on is, for instance, the yield composability. So being able to leverage swap LP tokens in other protocols so that you can have strategies which involve several types of yield, essentially. That's another way to do integrations.
One question that I have: will you still cater to the traders, like just a single trade being executed on, for example, your front end, or does the user only see a interface where they can provide liquidity and the rest is automated to these aggregators, for example?
So the way we see it right now is we tend to focus more on liquidity. Essentially, we think we have our value proposition for traders is strictly inferior to the value proposition of 1inch and Paraswap, because we are integrated with 1inch and Paraswap, and so they have our quotes. So if you're a trader, essentially you're always better off going with 1inch or Paraswap than going with Swap directly. So we don't think it makes sense to invest resources and money to try to attract traders, while Paraswap and 1inch are doing a better job than we do. And by the way, they have raised much more money, so they're able to raise to do epic parties in conferences everywhere in the world. And so we think it makes more sense for us to focus on what we really know and what we're really good at, which is building good strategies for LPs. And in the end, we also think it's going to be better for traders in the sense that by making more efficient strategies, we are also giving better fees to traders because, yeah, we are able to reduce arbitrage, for instance.
Yeah, so that's why you will come out on top if the aggregators are searching for a better price. When you have a better price on one side of the trade because you have lower fees, you will come on top and thus provide also value and fees for your LPs.
Exactly.
Cool. Yeah. And then on the LP side, what type of LPs are you targeting? Is that also like retail, or are you looking at institutional, maybe DAO treasuries? What type of LP do you want to see, or actually are you catering with this design?
So, I mean, in the end, what's the product that we offer at Swap, our protocol is our promise is to to give you more money out of your existing money. So I think it's a promise that appeals for a lot of people. And the main question is what are the assets that you want to do such yield on, and what's your risk profile? What's your risk appetite? So for the current product that we have, we focus both on retail and institutional, and we focus mainly on existing DeFi users. So we don't try to onboard external people to DeFi. And essentially because right now we're still a small protocol and we solve a problem that is very well known in DeFi, which is impermanent loss. So our current target is more retail DeFi power users and institutions that already use DeFi. In the future, we think that, of course, this could serve many more type of people, including DAO treasuries. So the big question with DAO treasuries is usually they want to provide liquidity on their token, and it's actually costing them a significant amount of money. So this is something we can help. We are not focused on it right now because we're a small team and we'd rather be targeted towards a specific audience before scaling.
Yeah, and I think like one part also of the target group is like what blockchains you are deployed on. So right now you're on Polygon. Could you go into like what are the reasons for that? I assume, I mean, as you need an Oracle, that needs to be fast and cheap, right? But are there also other reasons for that?
Yeah, I mean, the main reasons are the technical reasons. We wanted to build a product which is, as I said in the introduction, the main thing on which we distinguish compared to other AMMs is that we don't compromise on information and math. And regarding the information part, the more frequent the Oracle updates, the better our performance is. And Polygon has the highest frequency of Oracle updates among all EVM compatible chains. So for instance, like the feeds on Polygon are updated every 27 seconds, while they're updated every 30 minutes on Ethereum. The other element is the gas computations. So essentially, due to the math and the integration of oracles, usually traders experience 2.5 higher gas fees on Swap than on Uniswap, for instance. And on Polygon, it's not an issue because gas is super cheap. So what we do essentially, on Polygon, we estimate that we start to be competitive for trades that are above $6 because of the gas difference. And on Ethereum, at the peak of the bull run, we were competitive only for trades with 25K volume. And you need to be super, like, to cover for the gas fees, essentially. And you need to have a huge amount of liquidity in order to be able to support trades above 25K and be competitive around that, even on the pricing of the AMM. So that's why we decided to go on Polygon, because it allows us as well to bootstrap the network in a much more efficient way. And also, I think the structure of the users on Polygon is a bit different. So you have a lot of retail users, which I think is interesting, given our product has a very passive proposition. The idea is you just deposit your tokens, you go wherever you want, and you find them. You don't need to monitor your position or whatever. It's a stable and passive product compared to the other AMMs, which you need to monitor much more because there is much more volatility.
Got it. Makes sense. And do you plan to expand to other chains? And if so, which ones do you have in mind for now?
So currently the focus is not really around expanding to other chains. It's more around like building the V2 and building adoption, proving that the model works with a higher amount of liquidity. In the end, we'll probably go to other chains. I think the main candidates like long-term are the ZK rollups, because they, at least in what they promise, they seem much more scalable than other solutions. So which means that the Oracle frequency will be lowered, and we will be able to run even more advanced computations and integrate even more information. So this is like I would say like the long-term developments. Regarding optimistic rollups, we may go there medium term. It depends. Like we need to run simulations on how the oracles, because the oracles are less frequent on optimistic rollups. So we need to see how this could affect our performances, essentially.
Does the protocol has its limitations, because you're trying to reduce the risk for LPs, and that's always in the market. The market pays you to take risk others won't take. So if you're doing safer yields, does that mean that your yield from LPing is lower? Like can you give an estimation of the yield that users could expect on Swap?
Sure. So I mean, first a way to answer your question is, indeed, in finance, when you have lower risk, you have lower returns. But the main issue with AMMs today is that you have negative returns with huge risks. So it's a broken product. I mean, it's not really an investment product. Actually, it's more a casino product when you think about it, because when you have yields around like -1%, -2%, and you have a huge volatility, it means that you have significant chances to make a lot of money, but even higher chances to lose a lot of money. So essentially, you're playing the roulette casino game. And but I mean, totally agree with you. So Swap is like a low risk, low return market making strategy, at least Swap V1. And as I said, the idea is to expand into a higher risk strategy, which will provide higher return. The yield of the strategy, the net yield of the strategy, so net of everything, impermanent loss, etc., since its inception has been 2.5%. So if you compare that to Aave or Compound, it's actually 4 to 5x what they deliver on the assets that we list. Two times the risk, sorry.
Yeah, and you mentioned that you want to go more into the higher risk pools. Right now, you have like a tri pool with Bitcoin, Ethereum, and USDC. Do you have, for example, one eventually a strategy to do like single-sided LPing, and two, like, could you just in general tell a little bit more about your roadmap and where you see the pools going?
Sure. So essentially, yeah, we definitely are studying single-sided liquidity provision for V2. We don't know yet whether we will implement it or not, because it opens to other kind of risks essentially. So it's a trade-off in the end. So we haven't made that decision yet. The roadmap for the next months essentially is we want to deliver our V2. The idea is to deliver by approximately mid 2023, and in the meantime, it's mostly about like developing, like increasing the liquidity on the V1. For now, we really tend to be super focused. We don't want to spread out too much. So right now we're still building our products, our core products, and until like after we have built those core products, there will be a time for expansion to other chains, other assets, etc. But for now, the idea is to be quite focused actually.
Yeah, so I assume you want to see where you can integrate first, and as you said, like do 1 inch. Like, what integrations do you currently have, and what are you targeting? And let this also be maybe a shout out to some of the listeners that are working with some of these protocols that might want to integrate you.
So essentially today, the main integrations that we have are like with on the aggregator side with 1inch and Paraswap. And so yeah, we're very happy to have those integrations because they enable us to have trading volume on our end, so yield for our LPs, and on their end we essentially we provide good trading quotes for their traders, especially for the small trades. Actually, we are, for instance, on the trades that are below $100, we are approximately 7 times more capital efficient than Uni V3. I think it's a win-win situation here. And we are still looking to integrate other aggregators like 0x and Odos, essentially, in the Polygon ecosystem. Then we have integrations with, like dashboards or tools essentially for LPs to monitor their positions and to invest into dApps. So we have been integrated to DeFi Llama, T-Bank, for instance, Merlin, by Valk. And what we're looking to integrate right now is we're working on integrating with other dashboards like Dorian, with wallets like Ledger, for instance. So this is another category of integrations. And then the last category is more like integrations with all protocols to build products that are composable. So it's around the topic of yield composability that I was mentioning, and how do you use those Swap LP tokens, which are actually a high quality collateral, to do things with it. Because one of the advantages of having a low risk, low return strategy is that it's a really good collateral to borrow other assets. So we're working, it's more discussions at this stage, but there are several protocols we are working with to explore this aspect. So if any of the listeners thinks his or her protocol could be a good fit for Swap, don't hesitate to reach out.
Yeah, definitely. Like, reach out. You can also DM us and we will get you in contact. For the last question, I think it would be great for our listeners also to get to know the team a little bit more. Like, how many people are you? Like, what's the background? Are you hiring right now?
Sure. So we are two co-founders. So it's David is like more in charge of the tech research, and we're working on the product together essentially. So he's the one who designed Swap V1. His background is math and machine learning mainly. So he worked at various startups as an ML engineer and a head of research, and he has a degree in math essentially. And he notably studied very in great details stochastic models, which are like the models that we're using today in our design. On my end, I have more like a business background. I have a master in finance from HEC, which is the best French business school, essentially. And I spent 4 years in strategy consulting. In our team, we also have our research team, which we have partnered with, and which I have introduced a bit earlier in the podcast. So those are like mathematicians and researchers in market making who are helping us design the new strategies that we're going to use. And yeah, we're very excited to be working with them. Currently on the core team, we're a team of 7 people, and we're recruiting more people in marketing and soon engineers. So solidity and front end essentially.
Yeah, so if you're interested and you have your expertise in marketing, please reach out to Swaap, because they're looking for talents, and I think that's also a good way to prove your worth in DeFi, even if you aren't a developer. I think that lots of different skills are needed with all of these projects, and marketing is definitely one of those that I think a lot of projects could do better. So if you have skills in marketing, definitely prove that, and hopefully we'll see more of Swaap because of your skills. So, and then I think as the very very last question of this podcast, it's more of a philosophical question from my end that I like to ask people, like, where do you see DeFi going in the next 2 years? We're now in a bear market. Everybody says let's build in a bear market, but what's apart from new and better AMMs, what would you want to see in the market?
For me, the main problem that we have today in DeFi. So, I mean, first I'd like to put things into context. The liquidities in DeFi, the overall TVL is 50 billion. 50 billion is nothing. It's the size of the 50th American bank, if you want to compare that to TradFi. And I think, to me, the objective of DeFi should be to be the new infrastructure of the financial system. And basically, I think that this is what we should all aim for. And I think we're still pretty far from that. And this will probably take 10 or 15 years to happen, right? But I think what we should really challenge ourselves to do is like, okay, how do we become the new infrastructure of the financial system? And I think there are 3 blockers. The first one for me is the infrastructure. I believe that the current blockchain infrastructure that we have is not scalable enough to power a full financial system. And so I think that today we need to test and experiment new products with what we have in terms of infrastructure, but we also need to prepare to challenge our models with, like, by anticipating what the new infrastructure is going to look like and what it is going to enable us to do. And that's why at Swap we're really trying to focus on leveraging scalable computations, because we think this is the future and this is much more efficient than running on Ethereum layer 1. So yeah, what I want to see is progress in infrastructure and experiments made to leverage that. Then I think the other element which is key is probably UX, as DeFi is still very hard to use, be it for like a retail user or even an institutional user. And I think there are lots of challenges, like deep challenges, like around, okay, like for instance, around custody. Like, I don't think many people actually want to, I mean, not actually in the way that it is today, have the custody of their assets and risk losing everything because they forgot their seed phrase. I don't think that people want that, actually. that most people want that actually. So we need to find better ways to enable, for instance, self-custody along with which is in a much more user-friendly way, and also better probably, have a better user experience for people using DeFi products. Maybe communicate also better on the risks and the returns of financial products. Be more transparent about that would be also a great advancement. And then I think the last point, which is going to be important, is I think that there's going to, if DeFi really becomes the infrastructure of the financial system, there will need to be a form of regulation, which doesn't mean that we absolutely need a fully regulated DeFi, but there will be a part of DeFi that will be regulated. And we need to ensure that this happens in a way which is as compatible as possible with the ethos of decentralization. And I think this is not easy, and this is going to be a big challenge.
Those are all very valid points, and I fully agree. We could do better infrastructure so projects can build better, or people have a better insight of what happens on a blockchain. UX just to get more users, and have crypto available for the masses. And regulation is coming, but as long as we can keep that original ethos of decentralization possible, and we have experts from crypto helping with that regulation, that's where we will be better off. And hopefully it won't backfire, where people who don't know about this space are making judgments about what we're doing here. So I think it's a good note to end with those 3 points. Thank you, Cyrille, for coming on our podcast. If people want to learn more about Swaap or about you, where can they reach you?
Don't hesitate to reach out on Twitter. So it's Swaap with 2 A's, obviously. You can join our Discord as well. I think those are the best channels.
Awesome. We'll make sure to add the links in the description so people can just click them. Thank you for coming on. Thank you, Kepler, for being the co-host. And I'll speak to you in another Deus Ex DAO podcast.
Thank you very much for your time.
Thanks, everyone.
Great discussion. And thanks for listening.
Thanks for tuning in to the Deus Ex DAO podcast, a place where some of the most progressive and innovative builders, thought leaders, and traders in the crypto space come together to discuss all areas of the crypto industry. Whether you're into DeFi, Layer 1s, Layer 2s, NFTs, or anything in between, we've got you covered. And as a reminder, nothing said on this podcast should be construed as financial advice or as a solicitation to buy or sell any digital asset or security. The comments, views, and opinions expressed by the hosts or guests on the podcast are their own. As always, you'll need to do your own research.